Hi everyone, I'm Jay Tipton from Gordian Strategies, and welcome back to another episode of Untangling Climate Finance. Today we're talking about one of the most interesting developments in climate investing right now, the rise of retail access to compliance carbon markets. My guest is Valentin Lautier, or Val, or I'm going to butcher it in French, Valentin. Actually, that wasn't that bad. Anyways, the founder and CEO of Homaio, a Paris-based fintech that's opening the door for everyday investors to take part in Europe's regulated carbon market, the EU Emissions Trading System, or EU ETS. If you're not familiar, the EU ETS is the world's largest and most established regulated carbon market, the mechanism that puts a real price on pollution. Since its launch in 2005, the EU ETS has led to a nearly 50% reduction in industrial greenhouse gas emissions across the sectors it covers, notably power generation and heavy industry. Until recently, it was completely closed off to individuals. And that's where Homaio comes in. Val and his team are making it possible to invest directly in European carbon allowances, turning them into a new kind of asset that blends financial return with real climate impact. We get into how the platform works, the investment thesis behind EUAs, what differentiates compliance markets from voluntary markets, and the bigger question on how finance can accelerate decarbonisation. All right, let's hear from Val. Valentin, welcome to the show. How are you doing today?
Hey Jay, thanks for having me. I'm doing great. How about you?
Very good, thank you. Where are you calling in from?
I'm in Paris right now, and you are in Spain, I believe.
That's right. I am in a little village just outside of Madrid. Beautiful. And it is crazy windy here. It's nuts. We're having like a wind advisory. Everything's blowing over. We might get blown away, but let's see what happens.
Yeah, I think we're having a storm throughout all the western coast of Europe because we had one as well, like the wind advisory last night and this morning. It was insane. Riding on my bike coming to the office was just nuts.
Ah, okay. You guys are experiencing it there as well.
Yep.
Good to know. I wasn't sure if it was just here or what. Okay, that's because I was getting notifications that it was like ridiculously high levels of wind speeds. And I was like, this is nuts. So I guess Europe's always that way. It's kind of Western Europe gets hit with the same stuff. So not surprised. Anyways, why don't you give me your name, where you work, and I would love to hear a little bit about your career and educational background.
Sure. So my name is Valentin. It's a French name. So people just usually call me Val. I grew up abroad. I lived in Venezuela, Malaysia, Hong Kong. I'm French, but I arrived in France when I was 18 after graduating from high school. Studied a little bit in France, a little bit in the US. And when I was in grad school, when I was 20, I created a first company, which was called Skim. It was a fintech startup. We developed mobile payment solutions for consumers, but also for businesses. That was 15 years ago, a time when, the tech ecosystem and the venture capital ecosystem was just so much different. Super difficult at the time to build a tech company in Paris, but really got me hooked on entrepreneurship. And since then, I've been kind of building stuff in different sectors, not always in fintech, but always with technology. I did a little bit of architecture in virtual reality. I built a beauty brand in augmented reality. And for the past few years, I've been working in the intersection of climate and finance. And I'm now the founder of a company called Homaio, which unlocks climate grade assets. So financial products that combine real returns and a strong impact for private investors and family offices.
Beautiful. I did not know that you lived in Argentina.
Oh, Venezuela.
Oh, it's Venezuela. Sorry, Venezuela. That's even crazier.
Yeah, I mean, that was early 90s, so a whole other time as well. Beautiful memories from my time in Venezuela. Beautiful country.
Yeah, I bet. I meet a lot of Venezuelans here in Spain, as you might imagine.
Yeah.
I'm sure there's a good amount in France as well. Okay, anyways, so I guess this is a two-parter. You gave the nice background. What specifically was it that pulled you into climate finance, and then what sparked Homaio specifically?
I think what got me into climate finance is the fact that everybody has their kind of aha moment on climate, their eureka moments. And for me, it was somewhere around 2018. And I decided that the only thing really worth your while, if you're in your 20s or 30s or 40s in the 2030s, then the greatest challenge that we collectively have is solving climate change. Some might argue now that it's AI or I don't know, but I think it really is climate change. So that's where I want to contribute. That's where I want to work. And I looked at it, or I approached it with lots of different angles. And at the end, I realized what I do know is finance. I'm not an engineer. I'm not going to go into deep tech or like nuclear fusion or, small modular reactors or whatever, but I do understand finance. And one of the biggest challenges in solving global warming and climate change is solving the climate funding gap. So the $5 trillion of additional investments that we need every year in order to either mitigate the impacts of climate change or diminish emissions. And so how do you do that? That was kind of the big question. And that led me to what became Homaio. So the answer that I found is the greatest store of wealth is private wealth. Like if we need to find 5 trillion euros or $5 trillion per year, where are we going to find it? And that's private wealth. Then the question becomes, how do you steer at scale private wealth towards assets that have a real demonstrated impact? And that was the starting question and what became the thesis or the mission of Homaio. So that's kind of how I got into it.
Beautiful. Yeah, I think that you're right. I personally also kind of answered the call of climate. I was doing something completely different. So I totally agree that our generation probably feels that pressure. So I appreciate that you recognized that and re-navigated the direction of what you were doing to work in.
Yeah. I mean, I was working in, I was building beauty products. It was fascinating industry. But, at the end of the day, I was like, is this the best use of my time and my energy and my ideas? Maybe not.
Totally. Maybe not. Yeah. Mine was very similar. I was producing commercials for Reebok to sell, 1 million shoes.
Yeah.
So I feel you. Yeah. Good for you. Okay. So I would say that a lot of the conversations that I have on this podcast probably skew more towards the voluntary carbon market.
Ouch.
I know. But as you know, because we've had this discussion before, like I'm a huge fan of compliance markets because of their effectivity. I'm sure you're a pro at doing this. Let's talk about compliance markets, but let's use the European Union emissions trading system as like explanation, because I know that that's where a lot of Homaio's focus, at least up in this point, has been. I know that that's changing. So why don't you give us like the 101 on the compliance markets and specifically the EU emissions trading system, and then we can get more into the details.
Yeah, sure. Just to start off, I kind of said ouch when you said the VCM, the voluntary carbon market. Obviously, I'm super biased.
For sure.
And I love poking fun, or not fun, but just kind of teasing people working on the voluntary carbon markets. But in reality, it is a market that has its uses that I find necessary, that has promise. So I'm definitely not saying everything has to be thrown out, far from it. And I don't think you should actually oppose both markets. They both have a huge role to play in the transition. So this was just a gentle tease. I have lots of friends in the voluntary market, and we always have fun kind of teasing each other.
I appreciate that. The teasing is welcome.
Obviously biased because I'm focusing on the compliance.
Yeah, all good.
Actually, what's funny here, if I can take a step back before going on the European trading system, is that these two markets, so the voluntary and the compliance, have really bad names.
True.
Because there is a part of the voluntary carbon market which is actually being increasingly regulated, and there is a part of the compliance markets that in some jurisdictions and maybe also in Europe in the future will be covered by some sort of offsetting mechanism. So I don't really like the distinction or the naming of these two markets. The way I see it is you have on one hand an offsetting mechanism, and on the other end, a carbon pricing mechanism. And that is kind of the big distinction between the two. One aims at compensating emissions by creating a financial flow between an economic agent which emits greenhouse gases and another economic agent which either avoids or absorbs greenhouse gases. And that's the offsetting mechanisms. which can be more or less voluntary, more or less regulated. And then on the other hand, you have the carbon pricing systems, which is not between two economic agents, it's between a jurisdiction, so a government at the local, state, federal, national, supranational levels, and compliant entities. And the objective here is to put a price on emissions, not offset emissions, but price emissions. And I think this is kind of a fundamental difference. So now, how does it work? Well, the idea is in order to price something, you need to have a supply and a demand. Or you could have just an arbitrary amount, in which case it's a tax. So if you look at carbon pricing systems, you can subdivide them in two. You have carbon taxes and market-based systems, which are emission trading schemes or ETS. That's all clear for now, yes?
Yeah, 100%.
Awesome. So now if we look at the ETS, the idea is to let the markets set or define the price, discover the price that emissions should be priced at. So in order to do that, you can either play on demand or you can play on supply. And the way it works is jurisdictions that implement emissions trading schemes define a amount of emissions that can collectively be emitted by market participants during a certain period. So if we take a concrete example, in Europe, the European Commission, which is the governing body of the markets, will say, okay, we're in 2025. This year, we're going to identify a number of sectors which have to comply to the scheme. And collectively, they will not be allowed to emit more than, let's say, 1 billion tons of CO2. And how do we control that? Well, we issue a financial instrument, which we call an allowance, and which represents 1 ton of CO2 that can be emitted within the collective budget. So this collective budget is capped, and little by little, we reduce the cap. So we decrease the supply. And by decreasing the supply, theoretically, all other things remaining equal, the price should increase. And as the price increases, these economic sectors which have the obligation to participate in the market, which means to surrender a number of allowances equivalent to their annual emissions, have a greater incentive to lower their emissions by investing in decarbonization solution, because they're always facing a trade-off. Do I buy allowances, considering that the price of allowances increases year after year with a decreasing supply? Or do I invest in a solution which will reduce my emissions and therefore reduce my exposure to the scheme? Is that clear, or is it a little too theoretical?
No, that's clear as a bell.
Awesome. So if we take an example, let's stick with the European Union emissions trading system. Let's say the cap is, $1 billion for this year. So next year I'll be maybe 900 million, and the year after that 800, etc. If I produce sugar by heating beetroot with gas, I know that I will emit roughly 3,000 tons of CO2 for every 10,000 tons of sugar that I produce. So if during the year I've produced 100,000 tons of sugar, I need to surrender 30,000 allowances because I've emitted 30,000 tons of CO2 during the year in order to produce my sugar. In order to surrender to the European Commission 30,000 allowances, I need to purchase them on the market. So I go to the market at the organized exchanges where these allowances are continuously traded, just like, stocks are traded on the New York Stock Exchange or the NASDAQ or Euronext. Here you have European Union allowances issued by the European Commission, which are traded on organized exchange, which are called either the European Energy Exchange, EEX, or the Intercontinental Exchange, ICE, where the sugar producer can go and buy allowances. And they will buy allowances in an amount equivalent to their emissions and surrender them by the end of the year. The following year, they start again. If they're still producing 100,000 tons of sugars per year, they still need to buy another 30,000 allowances for that following year. But the difference is this year, the total supply has dropped and therefore the price has increased. Make sense?
Yeah, continue. It makes sense. Continue on.
All right. So what else can I tell you? This system has been in place for 20 years. And over the past 20 years, it has covered about half of Europe's total emissions. So right now, Europe emits about 3 billion tons of CO2 per year. And the scheme covers about 1.5 billion tons of CO2. It basically covers all the electricity producing companies, so power generation companies which burn gas or coal. It covers industry, so if you produce steel or cement or petrochemicals, sugar, paper, cardboard, glass, ceramics, you're covered by the scheme. When I say you're covered, it means you have the obligation to participate by surrendering allowances in amount equivalent to your emissions. And it also covers shipping companies and airlines for intra-EU flights. The market is expanding over time, so it covers more and more sectors. The track record in terms of emissions is 50% reduction over 20 years. That's 1 billion tons of CO2 reduced over 20 years. Like no other mechanism works on this scale and at this speed. And the price has been multiplied by 10 over 10 years. That's a 25% average annual growth rate. So you have here a financial instrument, which is called the European Union allowances, which is traded in a volume approximating 800 billion euros per year. So super liquid assets, which appreciates by design with a double-digit growth rate over a 10-year track record, and which is the most efficient and the first mechanism to reduce emissions on a pace and on a scale consistent with global warming. So to me, it is the holy grail of climate finance.
Yeah, I agree. Because you beat me to it. I was going to ask just like two basic questions. The first was, one, is it working? Which you just described that it is. And when you're talking on that large of a scale, it's very impactful, right? We're not talking 100,000 tons. We're talking way bigger, an entire like trading block, the continent itself. And then the second is like, is it generating climate finance? Which you said it is. And as you and I both know, and maybe some of the listeners, is that it's going to expand to cover other economic sectors that aren't currently covered under the first iteration of the EU ETS, which means that more emissions will be tracked and more emissions will be required or obligated to be reduced over time. When you cover more of the economy, you cover, I think it's transport is going to be added, maybe a couple others. Anyways, I want to get in how you guys fit into all of this, but it would be helpful to know as best as you can, like what is happening with the finance that's being generated from the trading of the allowances.
Yeah, there are two sub-answers to this. First, again, the allowances are financial instruments issued on the market by the European Commission. So in a way, very similar to a company issuing stock, when the European Commission issues new allowances, it generates revenue. And so last year, for example, it generated 40 billion euros in revenue from the issuance of these allowances. These 40 billion euros are then redistributed to member states, which have the obligation to use these proceeds to finance their climate strategy and energy transition strategies. So it's really a net inflow that goes into climate finance at the state level. Part of the revenues, so let's say 3/4 are redistributed to the member states, like 30 billion out of the 40 billion. And then the remaining 10 billion are used to finance different funds managed by the EU, by the European Commission, which either subsidize industrial modernization, technological innovation, or more subsidies to households that are exposed to the increased costs linked to the energy transition. So there's a social element, there's a technological and innovation element, and there's an industrial modernization element. So these are direct financial flows that go towards accelerating decarbonization and the energy transition that would not exist otherwise. Again, on a massive scale, like 40 billion euros in the European budget is not a detail.
No, that's huge. That's absolutely huge.
Yeah.
And as you said, it's a win-win, right? Because we're reducing carbon emissions, which we know that we need to be doing. And then it is generating finance that didn't exist before that is also helping the transition to reduce emissions. So it's like a beautiful whole circle.
Yeah, it's a redistribution mechanism. So it's really a pincer movement where on one end, you're subsidizing the base to transform. And on the other end, you're pressuring through an additional cost. And that creates kind of the second part of the answer. The first is these direct proceeds that are redistributed to member states and to these three funds. And the other source is that, as we've said, industries have to systematically weigh the trade-off between purchasing allowances or investing in decarbonization solutions. And so each industrial sector has what we call a marginal abatement cost of carbon, which is basically the capex that they need to invest in to reduce their emissions divided by the number of emissions reduced, right? So let's say I'm producing steel and I'm emitting 1,000 tons of CO2 per year. If I need to invest 5,000 euros to reduce this to zero, then my total investment is 5,000 euros. My reduction is 1,000 tons. So my marginal abatement cost, or the cost per ton, is 5 euros. Obviously, if you're a steel plant, in reality, it's not 5 euros per ton. It's more something around 120 to 150 euros per ton. Right now, the price of allowances is around 78, 80 euros. Let's say 80 euros. So if you're the director of the steel mill, you have to weigh the trade-off between buying allowances at 80 euros or doing an investment to reduce all your emissions, which will cost you 150 euros per ton reduced. So obviously you're going to prefer to buy allowances because it's cheaper on a per ton basis. But little by little, as the price of allowances increases under the pressure of a declining supply, your trade-off, your arbitrage is going to be in favor of the investments. So over the past 20 years, the increase in EUA price, it's done 10x over 10 years, has incentivized industries and power emitters and shipping and transport and airlines to massively invest in decarbonization. And that's been especially true in the power sector, who has a pretty low marginal abatement cost, which today is below the cost of allowances. And that's why we've decarbonized energy production on such a massive and rapid scale in Europe. And that's why now what's left is, cement and steel and transport, which will be decarbonized only and only if EUA, so European Union allowance prices, match or surpass their marginal abatement cost. So it really is the engine of decarbonization. It's the engine of investment and the engine of climate finance.
Yep. And we don't need to go into this, but I think it's a good caveat to present to the listeners is that this system is being replicated and has been replicated across the world in a variety of other countries. I think something like 25% of the world's carbon emissions are now covered underneath or under some sort of emissions trading system. We've got it in China, parts of the US, parts of Canada, a bunch of other countries are either developing their emissions trading systems now or like in the late stages of getting them up and going. And so, the EU emission trading system has also acted as like a guiding light for other countries that are trying to do the same thing and modifying it in whatever way that more sense for their political and their economic structure, whatever country they're in. But it's like also performed very well in that role.
So yeah, just to bounce off of that, the EU Commission actually has what they call a carbon diplomacy task force, which helps other countries kind of replicate the success they've had in setting up an ETS. And now you have massive economies like Turkey, Indonesia, Brazil, India, South Africa that are following on Europe's footsteps because it works and because Europe is launching its carbon border adjustment mechanism. Maybe we won't go into that today, which is really acting as a catalyst for other jurisdictions to set up emission trading schemes. That's why we believe, and maybe that's transition towards Homaio, that emission allowances, plural, so throughout the world, are going to become one of the dominant asset classes of the next generation globally. It already is $1 trillion asset, and it really has the potential to grow tenfold or more over the next decades. And so deploying kind of the technological and financial and regulatory infrastructure to make these markets accessible is, I think, one of the biggest opportunities of the next 20 years.
I agree 100%. Okay, yes. So let's pivot to what Homaio is doing. I think we've done a great job now of kind of setting the stage of what the system is and the value on many different planes. So I guess I would like to spend the rest of the time describing what you're doing and how investors can get involved. So why don't you start with your role in this?
Yeah, so what we're doing is quite simple, and thanks for putting a light on it. We saw a market that has huge trading volumes, great liquidity, a 20-year track record at appreciating prices and at decreasing emissions. And I wanted to buy allowances, when I discovered it in 2018. Like, wait, can I buy some? Like, it's only going up, and it's probably the most effective way to reduce emissions. The supply is capped, so if I buy a certain number, I'm essentially confiscating allowances from the market, which immediately lowers the available quantity of emissions in the system, but also puts additional pressure on prices. So it's like perfect alignment between my financial portfolio and my environmental impact. How do I get my hand on some of these? And I realized it's not possible. And then I became super frustrated because not only from an individual point of view, I thought it was interesting, but also from a sort of macro and societal point of view, like this is our most efficient weapon to tackle our greatest collective challenge. And I should be, as an individual in the democratic system, able to participate in it and make it better and make it more efficient and make it work faster and accelerate decarbonization trajectories. So that's what we decided to do with Homaio. We decided to build an investment platform which enables you to access European Union allowances with instant buy and sell orders, physical replication, which means we actually hold physical allowances. It's not derivatives. It's not, future contracts. It's not swaps. It's physical allowances that we hold and withhold from the market on behalf of our investors who can invest. So buy and sell at the live spot price at any time. And I think we're probably one of the first platforms in the world to do this. And now that we've succeeded in doing it for European Union allowances, we're going to expand to every other market. We're already working on the UK allowances. And then, other countries we've talked about previously, South Korea, New Zealand, Canada, California, you name it. We want to launch the infrastructure to make all these markets accessible.
Excellent. And so why don't you kind of give it a walkthrough in terms of if I, Jay Tipton, want to register on Homaio and go buy 1,000 euros or 5,000 euros versus of allowance, like how that looks?
Well, it's exactly like buying stocks or ETFs or crypto. You go on homaio.com, sign up. So you give us your email, your name, you create a password. There's a KYC, so basically an identity check, which takes a couple minutes. We verify your ID documents. You send us your bank details so we know where the money comes from. And then you have an account. Once you have your account set up, you can top up your wallet. So you send us euros, basically. And whenever you see a price of allowances that you like, you invest. So you put in 5,000 euros and you click on buy. And there you have your portfolio with your X amount of EUAs, which are backing your assets. You can monitor your portfolio in real time. So we always tell you what it's worth. You can actually burn your allowances if you want to. That's a little bit radical. You're essentially destroying the economic value behind them, but you're also destroying the allowances forever for everyone. So you can do that with like a subset of your returns.
Okay, I didn't realize that was a feature. So if I wanted to retire the credit that I had purchased, that will take it completely out of the market.
Yeah, absolutely. We launched a feature a couple weeks ago. That's why maybe you didn't see it on the platform. But yeah, we now allow permanent deletion of allowances from the European registry. For example, like allowances are up 30% year on year right now. So people can say, okay, I invested last year. I'm up 30%. I'm going to take 10% of that and destroy it and be happy with 20% returns. So that's kind of a use case that we're starting to see. But yeah, essentially that's how it works. So you create your account, you top up your wallets, you invest in allowances, you monitor your portfolio, and then you can either top up regularly, you can set price alerts to buy or to sell, you can burn, you can sell, or you can just hold for as long as you like and ride the wave.
Right, because I think what are the projections by 2030 that an allowance is going to be around 120 euros or something like that?
The analyst consensus is somewhere around 130 to 150. So it's about 2x from current price levels, which is basically 12 to 15% annual return. Of course, this is a projection. It's not a guarantee.
Sure.
The market is quite volatile. You know the market well. You know it kind of goes up and down very rapidly because it's driven by lots of different factors. But, we've talked about wind earlier in the call. If there's a lot of wind, then renewable energy from wind farms increases. So we burn less coal, less gas. So there's less need for EUAs. So prices can drop. If it's super, super cold during winter and we're all turning our heating on, then it's the opposite effect that will happen. Geopolitical effects with variation in energy prices. Like if gas goes up, then we all shift to coal, but coal emits twice as much CO2 for a given amount of energy. So we buy more allowances. If Trump goes crazy and gives us additional tariffs, then there's fewer export opportunities for industries. So fewer industrial outputs. So fewer allowances are needed because there are fewer emissions. So prices go down. So lots of different short-term demand factors, which create short-term noise, short-term volatility. And long-term, it's the fundamental supply reduction that drives prices. So we often say that it's a good kind of buy and hold investment, something to build a position in over the next few months and hold until 2030 and maybe beyond, benefit from this structural growth in prices linked to the systematic reduction of demand. But again, there's no guarantee. It remains a risky asset. There's a risk of loss of capital, and there's some volatility.
For sure, without a doubt. I mean, that's any investment, right?
Yeah.
And as I had said, we often discuss on this podcast, but also just in the day-to-day work of Gordian Strategies, the voluntary carbon market. And of course, there's all sorts of risk that come with that. Some of which are like what you touched upon, like geopolitical risk, environmental risk, things of that. So that, that's the nature of any investment, regardless of the market. If you're investing in soybeans, you're at risk as well of commodities, like you have risk as well. So I remember actually when Russia invaded Ukraine and how that impacted gas prices, because of course, Russia is a huge gas supplier to the EU, that impact on the prices of the allowance of the EUAs. And then as geopolitical systems work themselves out, and that took time, how prices then modified or adjusted based on, what was being negotiated at the European Commission and who they were going to source their gas from. So, I mean, these things happen, right?
Yeah, no, absolutely. You see it on prices all the time. Like more recently when, there are talks of a peace deal between Ukraine and Russia, then opportunities for gas inflows to go back to Europe, which should drop the price of gas. Yeah, it changes all the time, which is also why we publish on a monthly basis price report on EUAs explaining what happened during the month, all the price drivers, what we can anticipate in the future. I think we see part of our mission as steering capital, of course, but also creating, knowledge and understanding around these markets, which are fascinating and which, as I've said, are going to be one of the defining markets of our times. So we take our role as trailblazers on the markets super seriously, and we try to help our clients and our investors really understand what they're putting their money into. One of the best ways is be skin in the game and see your portfolio vary and try to understand what happened and when you do start building a larger and larger position, because these are, fascinating markets.
It's a lot easier to understand when you're in the game versus just reading about it from the outside. Of course, we have a variety of different ways to educate ourselves and understand abstract concepts that we're not involved with, but I personally always find it easier if I'm involved, but to each their own. Okay, so the last couple of minutes that we have, I would just like to hear what the future has in store for Homaio. And I know that you kind of touched upon this earlier as you were saying that the ETSs of the world are expanding and you've got your eye on that. So why don't you explain what's happening now and what do you think your 2026 looks like?
Yeah, be happy to. Now that we've unlocked the EU ETS, the next logical step is to do the same for all the other sophisticated, mature liquid markets. And there's a number of them, as I mentioned. We're very close to launching the United Kingdom allowance markets, and then others will follow. There are other products that we can build backed by these markets. So instead of having sort of a direct exposure to a single market, we can build baskets with global exposure. But there's also products that we can create that exploit arbitrage opportunities on the market. For example, there's a spread between spot and future prices, which create a great cash management opportunity for short-term placements. So there's lots of products to be built on these markets in general. And then there are lots of other categories to explore, right? Like if we go back to the source, the origin story of Homaio, it's the realization that some markets out there exist with huge volume, baked in appreciation, real climate impact, but they're not accessible to private investors. So I want to find the other ones. We found, the emission trading systems, but there are so many others. Some of the things that really excite me, for example, are the catastrophe bonds markets. So insurance-linked securities, which focused on extreme weather events and which basically shield infrastructure against the loss of insurance linked to increasing severity of extreme weather. That's a fast-growing market, but still super hard to invest in for private investors. Another thing that excites me a lot is climate litigation finance. So there are more and more climate litigation around the world because states and private companies fail to comply with norms that they have themselves put in place. And the only way that we respect collectively these laws and regulations is if we have enforcement capacity. But oftentimes, limiting factor is financing. So climate litigation financing is also another asset class which I find fascinating and which I would love to bring on the platform. So that's not 2026, obviously. 2026 will focus on the ETS markets internationally. But 2027, 2028, and kind of moving forward, I want to explore all these different climate grade assets, financial products with liquidity, with a track record, with strong returns, and with real impact, and make Homaio the category defining investment platform for climate grade assets globally.
I love it. I love the ambition. That's awesome. And you're very confident about it, which you should be, because I think you guys have just a great position right now in the space, and what you're providing is awesome. I hope that you're seeing more people get involved and get invested in, as you said, like the opportunity to expand and scale is huge. There's a lot of other markets that are either up and running or they're in development and looking good, especially as unfortunately like climate is getting worse. So there's a bit of pressure there. But anyways, that's awesome.
Well, thanks a lot. And I think I am confident, but it is difficult on a daily basis. It's a grind. And, having the opportunity to come on podcasts like yours and try to explain what we do, make these markets more accessible, more understandable, more clear is really what's going to make the difference between us succeeding in making them accessible to private investors globally or just dying out in silence. Thanks a lot for the opportunity and the invitation.
Yeah, of course. But I do have one last question for you. Please, this is how I always like to close out the episode, and it comes from Stoicism. Epictetus once said that what concerns me is not the way things are, but the way people think things are. And so if we adapt that to climate finance, my question is, what do you think is one thing that must be done to change how people think about climate finance?
I would say 3 letters, ESG.
Fair.
I think climate finance, we have to point to its starting date. It would be the UN report of 2004, Who Cares Wins, which basically said that you have a returns premium when you care about ESG. And they shown that statistically it was true in the past, etc. And that can launch the whole ESG craze. But because it's such a hard thing to define, it became anchored in a sort of what I call a normative reality. So a normative reality is something that exists because people sit around a table and say that it exists. So it's labels, it's standards, it's norms, it's conventions, it's methods. The problem with climate is that climate is a physical reality. It's not a normative or a conventional reality. And so we built over the past 20 years a framework for climate finance, which is anchored in norms and standards and methods, and not anchored in an empirical, measurable impact on the physical reality of climate. So we have to move away from the standards and labels and norms and move back to the reality of trees and rivers and glaciers and temperature. And I think this is kind of the big paradigm shift or the big perception shift that we have to create. And it really goes back to your quote. We think that climate is about ESG because we've said it was, but we have now 35,000 billion euros in assets under management in ESG funds globally, 80% of which is in Europe. What has been the impact on the physical reality of trees and soil and water and rivers? Nobody knows. And that's a problem. And that's what we have to fix.
Brilliant response. Brilliant. That is great. That is going to have me thinking the rest of the day. So I appreciate that. Like, how can I do that? So that was great. All right, Valentin, thank you so much for joining. I appreciate all of your easy explanations about I guess when you break it down, the ETS isn't that complicated, but maybe for someone that's never heard it, you did a great job of explaining it. And it's awesome to know what Homaio is doing today, how somebody like me can invest, and what you guys are looking forward to doing as you expand. So thanks for taking 45 minutes out of your day to connect.
Well, thanks. It was great. And you're right. It's not that complicated. It's just not familiar. So making it familiar will make it much more digestible. When you think about it, it's not more complex than, a stock or an ETF or whatever. It's just not yet in the public discourse. So let's kind of put it out there.
Let's do it. All right. Well, enjoy the rest of your week and your weekend.
Thanks a lot, Jay. You too. Thanks.
Ciao. Huge thanks to Val for joining and breaking down how Homaio is reshaping access to one of the most powerful tools in climate policy, the EU carbon market. We covered a lot in this episode, from the mechanics of the EUAs and their role in decarbonisation, to what it means to make climate investing both profitable and accessible. If you want to learn more, head over to homaio.com, where you can find their explainer on how European carbon allowances work and how they tie directly to emissions reductions. You can also subscribe to their weekly and monthly newsletter. I've included their website in the show notes. And from the GKS side, don't forget to subscribe and leave a rating for us on Spotify or Apple Podcasts. If you're on Spotify, tap the bell icon so you never miss an episode. Also, check out the audio version of our weekly newsletter Sliced, where we break down topics in climate finance, carbon markets, and impact investing. Okay, catch you next month for another convo, untangling the systems behind climate action and finance. This podcast is brought to you by Gordian Strategies.